Ever wondered how new businesses, those scrappy startups bursting with potential, actually get the funding they need to grow? I mean, we hear about venture capital and angel investors all the time, but what about good old-fashioned loans? Can a startup, still finding its footing, even qualify for a loan? That's exactly what we're diving into today, specifically looking at Fundera and whether they offer loan options for startups. Now, let's paint a picture. You've got this brilliant idea. You've poured your heart and soul into a business plan, maybe even have a minimum viable product. But you hit a wall: funding. You need capital to scale, to hire, to market, to actually bring your vision to life. Traditional banks, often risk-averse, might be hesitant to lend to a young company with limited track record. So, where do you turn? Online lending platforms like Fundera have emerged as a potential alternative. Fundera, as many of you know, is an online marketplace that connects businesses with various lenders. They don't directly lend money themselves, but act as a matchmaker, streamlining the application process and presenting businesses with multiple loan offers from different lenders. This can save businesses a ton of time and effort compared to approaching each lender individually. But the key question remains, are startups eligible? This is where things get a bit nuanced. The term startup itself is quite broad. It can encompass anything from a pre-revenue idea to a rapidly growing early-stage company. Lenders, naturally, have different criteria for evaluating loan applications. Generally, lenders look at a few key factors: credit score, time in business, annual revenue, and cash flow. For a very young startup, especially one that hasn't generated significant revenue yet, these criteria can pose a challenge. A low credit score, little to no revenue, and a short time in business can make it difficult to qualify for traditional term loans. However, it's not entirely impossible. Fundera works with a variety of lenders, including some who are more open to working with younger businesses. While a brand new, pre-revenue startup might face an uphill battle, startups that have been operating for at least a few months, have some revenue coming in, and can demonstrate a solid business plan, may have a better chance. Let's break down some of the loan options that might be available to startups through Fundera. First, we have short-term loans. These loans typically have shorter repayment terms, ranging from a few months to a couple of years. They can be a good option for startups needing quick access to capital for specific needs, like inventory or marketing campaigns. However, they often come with higher interest rates than longer-term loans. Another option is business lines of credit. These offer more flexibility, allowing businesses to draw funds as needed, up to a certain limit. This can be particularly useful for managing cash flow fluctuations or covering unexpected expenses. Again, the eligibility for a line of credit will depend on the startup's financial profile. Then there are SBA loans. These are loans backed by the Small Business Administration, which reduces the risk for lenders, making them more willing to lend to small businesses, including some startups. However, SBA loans typically have stricter qualification requirements and a longer application process. It's important to understand that Fundera doesn't guarantee loan approval. They simply facilitate the connection between businesses and lenders. The final decision rests with the individual lenders, who will assess each application based on their own criteria. So, what can a startup do to improve its chances of getting a loan through Fundera or any other lending platform? First, build a strong business credit profile. Even if the business is young, establishing a separate business credit history is crucial. This involves obtaining an EIN, employer identification number, opening business bank accounts, and establishing trade lines with suppliers. Second, develop a comprehensive business plan. This document should clearly outline the business's mission, target market, financial projections, and growth strategy. A well-written business plan demonstrates the startup's viability and increases its credibility with lenders. Third, demonstrate healthy cash flow. Even if revenue is still relatively low, demonstrating consistent positive cash flow can significantly improve the chances of loan approval. This shows lenders that the business is managing its finances effectively and can meet its repayment obligations. Fourth, explore alternative financing options. If traditional loans prove difficult to obtain, startups might consider other options like invoice financing, merchant cash advances, or even crowdfunding. These options may have different terms and costs, but they can provide valuable funding for early-stage growth. Returning to our main question, are startups eligible for loans on Fundera? The answer is a qualified yes. While very early stage, pre-revenue startups may face challenges, startups that have been operating for a few months, have some revenue, and can demonstrate a solid business plan have a much better chance. It's crucial to understand the lender's criteria, build a strong business profile, and explore different loan options. Fundera can be a valuable tool in this process, connecting startups with a variety of lenders and streamlining the application process. Remember, every lender has its own specific requirements, and the loan terms offered will vary depending on the startup's financial profile. It's always advisable to compare multiple offers and carefully consider the terms and conditions before making a decision. Don't just jump at the first offer you see. Take the time to understand the interest rates, repayment terms, and any associated fees. Ultimately, securing a loan as a startup requires careful planning, preparation, and a realistic understanding of the lending landscape. While it may not always be easy, it's certainly not impossible. By focusing on building a strong business, demonstrating healthy financials, and exploring all available options, startups can significantly improve their chances of obtaining the funding they need to thrive. With that said, thanks for watching, and until next time.